greatest pleasure to, oh, I forgot something. I just need to let you know that this webinar is actually funded, developed under a grant from the US Department of Education. And the department doesn't necessarily mandate or prescribe practices, models, or other activities, and doesn't control or guarantee the accuracy, relevance, timeliness, or completeness of any outside information, and doesn't necessarily represent policy of the department. So just to let you know that the full EDGAR is on screen, and let's go to the next slide. All right, so now we're going to get started, and it is my great pleasure to introduce to you Yusuf Mohammed, who is a volunteer with SCORE and has been for many years, and he's going to tell us all about himself and also all about simple steps for starting your business and funding options. So take it away, Yusuf.
All right, thank you so much. And I'd like to thank the entire team for allowing me this opportunity to do this presentation to NDI. I'm very excited. There's a lot of content that we're going to cover, so I'd like to go ahead and dive right in. So we're going to discuss simple steps for starting your business, funding options, and funding strategies. And this presentation is being brought to you by SCORE. And I want to tell you first about SCORE if you're unfamiliar with SCORE. Since 1964, SCORE has provided education and mentorship to more than 17 million entrepreneurs. SCORE is the nation's the largest network of volunteer expert business mentors, and is dedicated to helping small businesses get off the ground, grow, and achieve their goals. SCORE mentors are valuable resources for any current or aspiring entrepreneurs. SCORE mentors are experienced in all aspects and stages of business development, whether you're thinking of starting your business or growing your existing company. And my name is Yusuf Mohammed. I've been a volunteer with SCORE for about 21 years now, and I am a volunteer. In my full-time job, I'm the CEO of Houston FinTech, which is a nationwide real estate investment brokerage. We facilitate residential investment acquisitions. We do fix and flips. We do cash out refinances. We finance ground up construction projects. We also do commercial real estate acquisitions, office buildings, warehouse, retail, churches, hotels, etc. We also facilitate commercial business loans, so SBA loans, non-SBA loans, term loans, asset-based loans, accounts receivable financing, invoice financing, and more. And I sit on several national banking committees. I teach an executive MBA curriculum in business development and finance. And I want to discuss our learning objectives. I wanted to take the time to kind of go through in detail my background and experience to kind of set the stage that I deal with access to capital every day. I deal with business owners, aspiring, and those that have been in business for quite some time on a daily basis. And I have a unique perspective. And so I think you'll hear that during the discussion. So the learning objectives for today is funding strategies for your business. How are you going to use the funds, the use of funds, any exit strategies that you may have, funding and funding sources. What are the eligibility requirements and what banks want? You know, and before we get deep into the PowerPoint presentation, I want to talk just for a second about your current financial position, because that's very important. You should know your current financial position before you apply for a loan. Common mistakes on why businesses are declined. There's many reasons businesses are declined, but it's one common mistake that business owners make is not being prepared. And when you go in and talk to a banker, those bankers they're asking qualifying questions. And sometimes when you're not prepared, you give answers that will raise a red flag. So what do I mean being prepared? Let's take a look at that. Is your business in distress? That's very important, because if your business is in distress, looking to get access to capital or get a loan may not be the time for you to look for a loan. If you've had a loss in revenue, if you've reported losses in your tax history, those are red flags. And you're going to have to explain to a banker why the loss of revenue and the losses in your history of in your financial history. So those things you need to know prior to going to apply for a loan. Let's take a look at another point, a key point that I like to point out before you go and meet with a banker. You have to understand that the borrower must qualify as a guarantor and the business must be viable. So let's start there. Let's look at qualify. First, looking at it from on an individual level. What's your credit score? When I make the statement that you need to be prepared before you go and apply for a loan, when the banker is asking you questions, they're going to want to know what is your FICO score? What is a FICO? It's a type of credit score created by the Fair Isaac Corporation, FICO. It's a 3-digit number that ranges from 300 to 850 that lenders use to evaluate your credit worthiness. Essentially, the likelihood that you'll repay borrowed money on time. And it's calculated from the information in your credit report, including your past history. Now, you have to understand, when banks look at your profile, most people think that, again, if we were just talking about reasons banks decline a loan application, most people think, they draw their own conclusion. But banks look at your credit profile, not just the FICO score itself. So when they look at your payment history, they're looking to see, are you making on-time payments or late payments? What's your credit utilization? The amount of credit that is used compared to your limits. Very important. These are things that you need to know prior to. So when you're questioned, you're able to explain any irregularities in your credit profile. They want to look at the length of your credit history and the types of credit that you have, the credit mix. Or do you have credit cards? Do you have auto loans? Do you have other bank loans? Do you have mortgage loans? And they also want to look at recent credit inquiries. Very important. If you have a lot of inquiries, that could be one of the things that is a non-starter for a bank. Normally, after a year, some of the inquiries will not should not affect the credit decision, and it takes 2 years before it actually falls off. So let's talk about, again, your FICO score. While people often refer to my FICO score as if it's just one number, there's actually dozens of different FICO scoring models. And this is very important for you to understand. A basic FICO score, these are general purpose versions of the FICO score. You have FICO 8, you have FICO 9, and the newer FICO scores 10 and 10T. So there's many different FICO scores. There's industry-specific FICO scores tailored to certain lending types, such as auto loans. So there's FICO scores for auto loans. There's FICO scores for credit cards. There's different scoring ranges from 250 to 900. Why is this important? These are things that you need to know about your current financial situation, your position, before you go and apply. Because if the lender is asking qualifying questions, then you need to be able to answer, again, any challenges that may be identified in your in your in your in your profile. So we talked about the borrower must qualify as a guarantor, and the business must qualify as viable. So what's viable? Business has to have strong cash flow, strong credit. We talked about strong credit and sufficient collateral. Okay. These are very important that a banker can see. Understand, when a banker asks for your financial statements, they're trained in being able to look at your profit and loss, your balance sheet, your cash flow statement, and they're able to determine how well you manage your business, if the business is mismanaged, and how strong, again, your cash flow, your collateral is from your balance sheet. But it speaks volumes when they see your financial statements, opposed to most of us as small business owners. We're not accountants, we're not CPAs, we're not financial individuals, most small business owners. And so when we get these financial statements from our accountant or bookkeeper or CPA, it's Chinese to us. We try to understand it, and it's not like they give us our financials and then give us an a class or an overview on how to read it and understand it for us to understand what our financial position is. So let's move on to the next slide. Let's see. All right. So this is one of the things that I'd like to do when I'm talking about meeting with the banker. Again, remember, these lenders, they're going to ask qualifying questions. And the way you can be prepared before you go and apply for a loan, have your elevator pitch ready. So I like to look at this particular slide starting from the bottom, because you need to have your elevator pitch together so you can say who you are. And there's pertinent information that the banks are interested in, when most people, they're so passionate about their business, rightfully so, that they go right into, why they created the business, how passionate they are about the business. And the banker is not necessarily interested in that. They want you to be concise. They want you to get to the point, because they're trying to determine your eligibility before you complete the loan application. Now, they're going to allow you to complete this loan application whether they think you are qualified or not. But being prepared, you can have a conversation with the lender to qualify them, because you need to determine if they're going to have an appetite for your type of loan. So it's a two-way street. So one of the things that you need to also have, it says here under use your strength for your elevator pitch, then it says abbreviated presentation. Abbreviated presentation, we like to call a business plan. Most banks, when you come in, they're going to ask you for a business plan or a business description. Now, they're not asking for a 22-page business plan. You have to understand they want to get a sense of, who you are, what you do, but they really want it to be comprehensive but concise. And a comprehensive but concise business plan, if you will, should only be about a page and a half to no more than 2 pages. So let's talk about what should be included in that abbreviated presentation or that business plan or that business description that will help the banker determine your eligibility. So one of the things you want to start with, you want to put your business legal name, you want to put your location, you want to put your corporate structure, state of incorporation, ownership percentage. Now, most people, when they put together these descriptions to give to the bank or these business plans, most of them want to tell the story of their business. The bank wants to get to the point. So the reason they want to know the legal name, the location, the corporate structure, the state of incorporation, the ownership percentage, that tells them immediately, are you a sole proprietor? Are you a mom and pop? If you have a corporate structure, what is that structure? Are you incorporated in this state? Is this a partnership? Do you have multiple partners? Because that plays into, if are we going to need multiple people to be on the application, or is it going to just be you? They need to understand your principal business activity. You need a description of the business. Say, for instance, you have a storefront and you're looking to do a build out. What's going to be the term of the lease? What are your different revenue streams? Now, again, this is going to be it's going to be comprehensive, but it's going to be concise, because these are the things that the bank really wants to understand about your business. But you're going to keep it no more than 2 pages. You need to also include, how much money are you looking for? What are you going to use the money for? How long? And the amount of equity. I want to stop right there because I want to do a live case study. Now, as I said earlier, I teach an executive MBA to existing business owners. I do pop quizzes. If this was in person, I would do a pop quiz. So because I can't see you all, I'm going to do a live case study. How many of us have ever gone to the bank and the banker says hello, you say hello, and the first question they ask you is, well, how much money do you need? And you say, I don't know. How much are you going to give me? That's a red flag. If you've ever done it, don't do it again. That's not a good look. And it's going to create a red flag. Now, some people think, why not? Where you need to put that information is in this description. How much do you need? What are you going to do? What's the use of funds going to be? How long do you need it? What's the amount of equity you have in your company? Then you need to have some information about you as the owner, and what's your qualifications. Talk about your management team and your employees. Again, depending on how much you're asking for, these points that I'm discussing become very important. You need to talk about your net addressable market, your marketing budget, and your approach to acquiring customers. So you can mention your customer acquisition cost. Very important. You're going to talk about your competition. How many competitors do you have in the area, say a 5 to 10 mile radius of your business? Talk about relative pricing and what makes you different from your competitors. Do a summary of projected revenues. They definitely want to see the numbers and what your projections are, what your expenses are, what's your debt service coverage ratio. We're going to talk about that in detail a little later. What's your profit margins? What's your customer days and your cost per customer? Put on there, what's your credit score? What's your minority status? How many jobs do you look to create? What's your personal assets and your spouse's income? Now, this is the type of description. Imagine when you meet with this banker, you give him your elevator pitch. You hand him this or her a 1 or 2 page description of your business that's comprehensive, as we just discussed, but it's concise and it's just written within these 2 pages. Now he's sitting across from an individual who understands their business, who understands their market, who understands their customers, who their ideal customer is. They it's a different conversation when you're going to the bank and you're prepared and you're not just going to the bank and trying to tell your story. All right, so now let's start at the top of this. Getting your foot in the door, knowing your financial SWOT. Most people, when you talk about a SWOT analysis, you're used to hearing about those terms in a business plan, but you should have a financial SWOT. Again, we're talking about being prepared before you meet with the banker. Now, this is an opportunity where you can actually start to talk about your business. What's your strengths? Tell them what's going right. All the things that you're doing that's resonating with your customers, that has allowed you to gain a market share. Um, you know, this is your opportunity to talk about your strengths, but you also need to be prepared to talk about your weaknesses. You need to have a conversation now before it comes out later, because they're going to find out the skeletons in the closet. So if you have the conversation about your weaknesses now, you can have a conversation with that banker, and hopefully they'll be able to either reassure you that there is still light at the end of the tunnel, or that may be um, a hurdle that we can't cross. But you need to be able to talk about your strengths and your weaknesses and the opportunity that exists. This is why you're here. So you're going to talk about the opportunities, your assess your the opportunities that may exist. It may be a seasonal business. You need to get a loan to get inventory up because we're going into the fourth quarter, and you want to be able to take advantage of the customer rush. Whatever that opportunity is that has you now looking to come and talk to a banker to try to get this loan. And then you also need to discuss the threats. This will be a realistic conversation that you're having with the banker. And again, this just shows them that you understand the business, the strengths, the weaknesses, the opportunities, and the threats that exist. It could be new competition coming into the market. It could be online competition that's coming into the market. So there's going to be, this should be a sobering conversation that hopefully at the end of it, you'll be able to make the banker feel like, this is definitely someone that we can work with, and we're seeing what we need to see, hearing what we need to hear in this conversation. So let's talk about use of funds and what your assumptions are going to be, what your projections are going to be, and what you forecast. This is why you're there, to get the loan. And this is what banks want to hear. They want to understand, what are you going to do with the money once I give it to you? Your assumptions are, Mr. Banker, I need this money so I can grow the business and drive sales. We are a restaurant. We started small. We only opened Friday, Saturday, and Sunday to start off. We became a hit. The word spread. We were able to open 7 days a week. We were able to hire new staff, and business is really growing. And now we've outgrown this current location, and we're looking to open a new location. But in opening that new location, it will give us larger space, a larger kitchen. We'll be able to now start to package, our own brand of, coffee or whatever product you may have, which, again, these are the assumptions, and and these are your projections. You'll be able to now, with the new packaged product that you couldn't produce in the old kitchen because you hit capacity, it was too small, you didn't have everything that you needed. Now with this loan, you'll be able to increase production and your service capability. So in this new location, you're now able to add new equipment and automate and upgrade the software and the technology and bring in more staff because again, you've gone from a small, maybe caterer, went to a food truck, you took the leap and opened a small facility. And again, your business has been growing over time, and this is a natural step. This is what they want to hear. They want to know that, you know, that you do have an idea of how you're going to use this fund, the funds that they're going to lend you. That's why the case study was such a bad idea or raised a red flag. Because if they ask you how you're going to use them or how much money you need, and you say, I don't know, how much are you going to give me? They know you don't have a plan. And if you don't have a plan, like we're discussing now, this is assumptions, right? But these assumptions, you're now going to create projections and you're going to forecast. In your numbers, you're going to say, with this money, as we train additional staff, we replace a worn out delivery van, it will allow us to boost profits because now you're packaging your own label products that you couldn't package in the other facility. So now sales can not only shift from in person, you can start doing e-commerce and you can take advantage of volume purchase discounts, lower cost. This is that opportunities part that we talked about in the SWOT analysis. Increase staff productivity. Now, also, you'll be able to manage the cash that's in the business. So a part of the loan could be to consolidate some of the debt or build inventory for the busy season, handle seasonal cash requirements, or secure funds for a one-time unplanned expense. So again, you know, this is the type of conversation that a banker wants to have with someone that's prepared when they come and apply for a loan. Every time they ask you a question, you're prepared and you understand what you're going to do and how you're going to use the money. So let's now talk about strategy, funding strategies. So, you know, this is part of the presentation I really like. I like all of it, you know, parts, because again, this is what I do every day, helping business owners get access to capital. And there is a strategy to it. You know, most of us, when we think about getting a loan, we only know of the, you know, the larger financial institutions that when we drive by every day, we see their signs outside or we see the advertisements on television. But there's other banks, there's other lenders out there. We're going to talk about some of those that are actually lending to small businesses. And I want to kind of talk in different categories here because, you know, a startup is different from funding an existing business, right? And an existing business that may have been in business for quite some time and their revenues are, say, you know, over $1 million. They have, you know, it's a different conversation that we need to have. And we're going to touch on some of it. That way we can kind of touch on who may be in the audience. So let's start with I want to start with startups because those are the most difficult to fund. When I say most difficult to fund, most small business owners, whether you're a startup or other, most small businesses look for 25,000 or less, believe it or not. And there's different institutions that have an appetite for small loans like that. There's others not so much. There's other small businesses that have been around for a couple of years, and their lending requirements may be more. So they may be looking for 150 or less. Now, there's more banks that have an appetite for those size of companies, and we'll talk about those institutions as well. And then larger institutions that are looking for 350 or a million plus, we'll talk about options for those as well. So let's start with that startup, that mom and pop, someone who may be working full time, looking to start a business or buy a franchise. What options do they have? Well, because banks look at historical data, they're going to ask for financial statements, and we'll get into the details of what they're going to ask for. But those are the things they're going to ask you for initially. How long you've been in business? Do you have any financial statements that we could take a look at? Tell me about the business. We already went through that. If you're a startup, you don't have any of that. You're looking to buy a franchise, or you're looking to start a business down the street. So where do you get started? Now, I like to always talk about business credit cards. I'm not saying this is a long-term solution by any means. And I know some people, when you say business credit cards, oh my God, that's 25, 30%. Why would you recommend it? Hold on before you crucify me. Just hear me out. There are business credit cards that only report the debt sits on your business name, not your personal name, so it doesn't affect your debt to income ratio. That you could get this business credit card with 12 to 18 months interest free. And some business cards, depending on your income, you can get 150,000 plus in the, as far as credit, with that business credit card. And some of them will allow you to access cash from those business credit cards. So it's something to look into, because one, they're for everyday purchases, you get rewards. Again, it's short term. And if you're starting new, this only takes, 10 days, maybe a week or two. It's very short period of time to apply. Most of the times when you apply, right away. And it just takes them long enough to mail the card to you in the mail. So it is an option that I like to tell small businesses to consider, because it's going to be more difficult for you to walk into the bank and get a loan as a startup business. Okay. Now let's talk about business loans. And now this may be for companies that's looking for, I say 150,000 or more. You're looking to finance major purchases, or you have a one-time cash need that is, it wouldn't make sense for you with a business credit card, or you already have business credit cards and you need the cash to make these purchases. First, let's talk about the different types of business loans. So you have secured, you have unsecured, and we'll talk about later in the slides those that are unsecured, what the requirements are to get access to those unsecured, what are the benefits to the unsecured, because when you're talking secured, you have to have the collateral. And that's when the SBA comes in handy. They come in, really good for small businesses. And we'll talk about that a little more in detail, because if you don't have the collateral, but you need that loan that's larger than your average loan size, then that's when SBA comes in, especially if you have real estate, and depending on what you're looking to do. Again, we're talking funding strategies, and I want to talk about, as we're talking about business loans, this is debt, and it must be repaid. There's monthly principal and interest payments that need to be made. Now, there are what's called term loans. Uh, Most term loans, depending on the type of term that you're getting, whether it's unsecured or secured, you can get term loans that are 6 months, 12 months, 18 months, 24 months, 3 years, 5 years, 7 years. The longest term you're going to get is going to be 10 years, unless there's real estate attached to it. With SBA, you can get a 25-year term. Now, I want to go back and talk about some of these smaller companies that have, only a need for, say, 25,000 or less. I want to caution you all, because sometimes, you know, those of us that are starting, and we can't get access to capital, you now have these merchant uh, cash advances that are readily available. And I want to caution you, because sometimes those are daily payments, they're weekly payments, and it really hurts your cash. Um, you know, when a bank is looking at your cash flow, because all of these loans, banks want to know um, your liquidity. They want to understand that you have the capacity to repay these loans. So I'm going to talk in some financial terms, but hopefully I'm setting it up properly where you understand cash flow, liquidity, same thing. All right. That's what they're looking for. They always want to understand your liquidity. It measures your company's capacity to repay its debts when it's due. So again, one of the reasons when you go and meet with the banker and he asks for your financial statements, what he's doing, first thing he's doing is looking at your balance sheet, and he's doing what's called a quick calculation of your quick ratio. How many of us have ever heard of a quick ratio? Quick ratio is an asset test for estimating at a glance whether your company is facing immediate liquidity problems. So the bank wants to know how liquid you are. And then they also may run what's called a current ratio test. That current ratio is used by bankers to demonstrate your level of solvency. The rule of thumb, your quick ratio should be around 2. But we're not going to get into the weeds on the ratio numbers and all of that, because oh my God, it's 1:42. Only have 20 minutes, and I don't think I've went through very many slides, so we have a lot of ground to cover. But I don't want to miss anything, because these are very important to those of us who are starting and need to be prepared and understand what preparation looks like and what the banks are looking for. And so these quick ratios and current ratios help them to determine your how liquid you are and your cash flow. So when you get these merchant accounts and they're now debiting your account every day or every week or twice a week, it made sense when it was so easy for you to get it, because it was just an online app that you had to do, and they sent it to you in 3 days or a day or 24 hours or same day. There's so many companies out there that make it very easy for that market that's looking for under 25,000 to get access to these cash advances. But it really hurts you when you're looking to get higher loan amounts. And so I need to make up some ground. Let me continue to talk about these different funding sources. So some of the other funding sources, you have online lenders, which we're starting to discuss. You have fintech, you have peer-to-peer, you have crowdfunding, the Department of Agriculture and Rural Development, You have the Department of Community and Economic Development. You have what's called CDFIs, which we'll get into the definition of those, equity investors, and family and friends. So again, now we're talking about funding strategies. As a small business owner, I started with credit cards because when you're looking to get access to capital, you need to know what's out there. Most small businesses don't know that banks have an appetite for certain industries and certain loan amounts. There are certain banks, if you're applying for less than 150,000, they really don't have an appetite for the loan. Now they're going to allow you to fill out that credit application. Let's get that clear. But that doesn't necessarily mean you're going to get to the finish line with that bank. And they're going to send you that standard, we looked at your credit profile didn't meet our criteria. They're never going to, tell you, well, we looked at your quick ratios. We did our calculation to see what the debt service was. And they just didn't have an appetite for that size of loan. So you have to understand, okay, well, what else is available for me based on the size of my business and what I'm trying to accomplish. So that's what this tree represents. So we all know family and friends. Hopefully, they believe in us, and most of the times they want to see us successful, and it can be easier to obtain than alternatives. And they may give it to us at a lower interest rate. They may not even charge us an interest rate, depending on which family member it is. Now, it can add strain to the family or friendship relationship if things don't go as planned. You may be new at this, or you may be taking risk in something new that hasn't been proven, and they're not requiring you to have a plan and everything we discussed prior to this. And so they just give it to you because they want to see you successful, and it could put a strain on the relationship. Or you can go to equity investors, angel investors, venture capital, outside investors. Now, again, these investors provide funds in exchange for ownership share in the business, whereas debt, there's no requirement for ownership interest. You control the business, you have creative control, it's a loan, maybe at whatever interest rate, which is reasonable. Now, some of these investors may have a higher ownership requirement of the business. Typically, there's no payments. Investors are seeking a share of the profits and proceeds from any ownership sale. Some investors are experienced business owners and can provide some practical advice and may want input in the business decisions. And finding the right investor can take a long time, because most investors, they're looking for something in particular, and they need to connect with you as the individual. They want to understand your story. They want to understand your passion. They're looking for something a little different from the bank. They may require some of the other things that we discussed, but they're more interested in if you have the capacity, the capabilities as an owner to make this happen. Now, a community development financial institution, I highly recommend this for those who may be smaller, who may be a mom and pop or 2 or 3 man businesses. The reason I say that, because typically they serve community businesses, small businesses, micro enterprises, nonprofit organizations. They do commercial real estate deals, affordable housing deals, and they're financing for businesses to spark job growth, for you to hire more people in the community, and in hard to serve markets in particular, and they're tailored to small early stage businesses. Now, most of these are still going to require financials. So if you just started 3 weeks ago, or you only been in business 3 months, they cannot help you. However, if you've been in business a year or 2 years, your credit scores 580, they will typically look at the business plan, look at what your plans are for the community and how many people you're looking to hire, because they have a different, they're not regulated by the banks. They actually are funded. The banks give them donations, um, these CDFIs and micro lenders. So their objectives are different. Online lenders, fast decisions on loans and quick funding, sometimes within days, again, sometimes in hours. Predictable monthly payments depends on how long is the term? Is it 12 months or 18 months? And it depends on your credit score, because some of these online lenders, they're not going to ask for financials, but they're going to ask for bank statements. Some of them may ask for 3 months of bank statements. Some of them may ask for 6 months of bank statements. And they review these bank statements just like a lender will look at the financial statements. So they'll look at, what do I mean by that? They'll look at your daily balances. They look at your ending balances. They look at, um, uh, you know, how much are you in your daily balance? What's the percentage of, money that you're leaving into the account? But they can also see if there's automatic payments that are going to other lenders like these MCAs, and they can determine quickly, what's your debt to income and what you qualify for. So with these online lenders, you can go on and tell them, oh, I'm looking for $50,000. They do their credit analysis and they may come back and say, oh, we'll give you, 30,000. But these online lenders, most of them, their eligibility criteria, you have to be depositing at least 30,000 a month in order to just be eligible for them to consider your loan. And what's important to know, when they look at your bank statements, if you have a lot of NSFs over that 6-month period, that's going to be a decline. If your income drops significantly over that 6-month period, they're going to first ask to see what's the explanation. Sometimes the explanation is good enough for them to still give you the loan. Sometimes it's not. And the predictable monthly payments, depending on the approval, there could be bi-weekly payments. All right, I have 8 minutes left, and I think I'm not even halfway through this presentation. Again, this normally is a 2-hour presentation. And when I teach it in class, it takes us 3 hours and a couple months to do it. But we're doing a condensed version, and I'm trying to focus on things that I think are very important. I don't know what stages your business may be in, but when it comes to funding strategies, it's important that you know what's out there and what the requirements are and how prepared you need to be. All right. Now, there's peer-to-peer lending sites. The borrowers, if you have lower credit scores, you may qualify for lower interest rates and other options, fast application process. Most of the online lenders, peer-to-peer lenders, they're going to be a little more flexible with credit score. Like the online lenders, you can get a loan with 600 credit score. Obviously, the lower your credit score, you're going to start looking at weekly or daily payments that's going to mirror a MCA loan. I really want to try to encourage you not to go the MCA route, although they're very easy to get. I want to encourage you not to go that way. Crowdfunding works best for funding new products, requires excellent marketing campaign and social media savvy individual, strong social media following. Crowdfunding has become a phenomenon, like a lot of these online platforms. Fintech, now obviously we are fintech, refers to companies that use advanced technology to improve financial decisions. It encompasses a wide range of financial services from mobile apps to online lenders, and it may be easier to get your loan approved by a fintech company, but interest rates may be higher and loans may be due sooner, which is not always the case. With fintechs, we just use the technology to help one place you with a bank that has an appetite for your loan. So we're able to match you. Whereas you just walk into a bank, you can only get the products and services that they offer. And sometimes, based on what your needs are, that may not fit. And they won't tell you necessarily where to go to find a good fit. They just let you know we can't help you. Whereas with us, we take the time, we match you, and the likelihood of you getting approved is higher. SBA, I'm going to talk about SBA because SBA is what's called the lender of last resort. So in order to be eligible for an SBA loan, there's a couple different eligibility criterias, but one of them is you need to be turned down by another lender. Um, Meaning you can't get credit elsewhere. That's their term. You can't get credit elsewhere. You may be at a bank that approved you, but the terms are not achievable, or they may have just, turned you down. So SBA is great. They have loan guarantees. They don't lend directly. Now, when you talk about PPP and EIDL, those were economic, injury, disaster loans. SBA managed that themselves. That's not normal. That's a disaster. Now, in disaster situations, they do have a disaster program, but when you're talking about small business loans, they're going to go through SBA preferred lenders that are eligible to do these loans on behalf of SBA. And the lenders like it because if you don't have the collateral to collateralize the loan, the SBA will guarantee 75 to 85, sometimes 90% of that loan. Banks don't like risk, so they love the fact that the SBA will guarantee a portion of that loan. Department of Community and Economic Development, Department of Agriculture and Rural Development. I have 3 minutes left. And so I'm going to ask my host how they want to handle this because I think I still have quite a few slides and I want you all to be able to also hear about the grants, and I also want to answer some questions because I do see the chat very active. So I want to ask my host how you want to handle this.
Sure, Yusuf. So I think maybe if you want to pause and address some of the questions in the Q&A,
Okay.
we can give you until about 3:15, and that should leave Ruth plenty of time to go through the grant slides and close us out. So if you want to take, maybe 5 minutes to answer some questions and then, see if you can get through a few more slides, I think that would be fine. You're welcome to use another 15 minutes, however it makes the most sense to you. I did encourage anyone who put a question in the chat to copy it into the Q&A box so that they're waiting there for you, nice and easy to view.
Yeah, this is great. Thank you for all the questions. Do you mind if Ruth does her presentation on the grants and I can look through the questions and then I can answer some of those questions?
Sure. Ruth, are you ready? We'll zoom over to your slides. And then that'll give Yusuf maybe 5 minutes or so to look through the Q&A and be prepared to answer some questions.
Sounds good.
All right. Over to you, Ruth.
You can see. All right. Great.
Hello, everyone. I'm Ruth Chavez. I'm the Small Business Specialist here with National Disability Institute Small Business Hub. We're going to go over quickly just a few points on small business grants because we have many business owners that have questions about this. So what is a small business grant? Small business grant is money that you do not have to pay back. There are no terms or interest rates tied into these type of funds. So it's a little bit more flexible. Grants are typically available to nonprofits, and at times there are opportunities for funds for small business that are for profit. Give me 1 second, sorry. Okay. Does that sound a little bit better? Let's see, I'm going to put my volume up a little bit more. Okay, so grants are funded by government agencies, nonprofits, and we are seeing a larger increase from corporations. Next slide. And something you should know about grants, as Yusuf has explained, when it comes to business loans, there are some questions that come about specifically for the small business grants. Depending on a criteria is how there's a selection for these opportunities. So that could be based on business industries or sector types, like restaurants or brick and mortar, for example. It could depend on geographical location, the size of the business, whether it's 1 employee or 20 plus. The stage of the business is usually a very common criteria. And then also the business mission or focus, whether there's a community aspect to that aligns with the business as well. Next slide. And so this question, explaining your why or the statement, it usually comes up a lot in our sessions with our clients. A lot of times we ask, as Yusuf mentioned, what is the purpose for the funding that's going to be used for your small business? And a lot of times they don't know or don't have at least an idea of the amount that they would need as well. So when filling out these applications, or at least reviewing beforehand, you want to make sure do you qualify for these grants? And also, does this amount make sense based on where you're starting? So when you are filling out the grant application, the majority of the times they would like to know what will be the purpose. And if you look at on the slide here, we have a vague example. The funds will help me with marketing to start or grow my business. A stronger response that we would, as a suggestion would be to really include a little more detail into your statement. And that is with, as a stronger response example, I plan to use about 40% of the grant funds for marketing to help more people learn about my business. This will include things like social media ads, Google search ads, and email marketing. These efforts will help attract new customers, increase sales, and support an overall growth of my business. So as you can tell, it's a little bit of a difference. You get a little more detail as to what would be the purpose of those funds that will be used for your startup or for your existing business. Next slide. Now, where to find small business grants? There are some government websites to consider or to recommend. Grants.gov would be a great place to look into some of those grants. Majority of the funding that's available is for nonprofit, but at times they have those opportunities for for-profit businesses as well. SBA.gov is another one, and SBIR.gov if you're in the high growth, high tech arena, as well as in your local and state government. There is in every county or jurisdiction or city, town, there is an economic development or corporation. They also provide support for entrepreneurs, but provide opportunities, whether there be small business grants or tax credits as well. And in order to locate your local EDC or economic development, the links are on the slide. You can click on the economic development tagline and it'll direct you to a searching a local search site. As well, another recommendation is to reach out to your local Chamber of Commerce. At times they have competitions or grants or some type of funding to support you as well. Next slide. For private and corporate grant opportunities, you can find grants at helloalice.com. They offer grant opportunities in partnership with other private corporations. So for example, Coca-Cola or Verizon, etc. So those opportunities roll out on a quarterly or monthly basis. You always have to go in and check to make sure, of any new opportunities that may come about. As well as we recommend to visit Verizon Small Business Digital Ready. We'll put the link in the chat for you. At this moment, the grant opportunity has closed, but to prepare, you would want to participate in 2 courses to be eligible to unlock the grant once it reopens. Another suggestion would be the pitch competitions. So if you are in, for example, we have a pitch competition coming up for the state of Maryland, Maryland only businesses, and that's for $10,000. So you want to do your search on Google search and see if there are any other opportunities based on the industries or location, geographical, like I mentioned, but there are some opportunities that may be available. Next slide. And just a little bit about the Verizon Small Business Digital Ready. It has a learning platform. You have opportunities to take micro learning modules, live events. You have the opportunity to network with other small business owners. They have a funding marketplace. And like I mentioned, the $10,000 grant opportunities, they roll out a couple times throughout the year. So you would want to sign up to be notified. Next slide. And just some tips as you are doing your searches for small business grants is to set up a Google Alerts and also signing up for newsletters, whether it be for your Chamber of Commerce, Small Business Development Centers, the EDCs, as we mentioned, and any other organizations that do support for economic development or small business entrepreneurship. That may be, a way to capture some of that information as it comes in. I would recommend for you to create a separate email address or account as a suggestion where you can have all those emails coming through and you can filter through them or tag them in a way where you can find all the grant opportunities a little bit easier. As well as one of the most important to consider is also networking with other small business owners and local organizations. A lot of times is, word of mouth that you would learn about any opportunities that come about. So, that is a suggestion. And a lot of times, a lot of my clients are small businesses. They also learn about other opportunities apart from grant funding by networking. Next slide. And I believe this is the last slide, if I'm not mistaken, but we wanted to share a list of our previous archived webinars that kind of go over a little bit more on tips on grant writing, the SBIR funding opportunities for your high-tech businesses, how to write an application, preparing for accessing capital, and blending funding for self-employment. So you'll be provided with these slides and the links so that you can take advantage of those archived webinars.